All right, I think we are live here. Hello and welcome everybody to today's workshop. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning and this page. And every Sunday we do our best to bring you a workshop that will hopefully increase your knowledge, make you a more educated investor, and when it comes to getting ready for retirement, put you one step closer to that so that you can retire with confidence. So if I haven't met you yet, welcome. This is something that a lot of folks do enjoy. So hopefully you want to join us on Sundays. And if you can't make it on Sundays, the video will be here for you to watch after. So no problem at all with that, no requirement. But we'd love to have you live because we do generally offer a Q&A at the end, and I will answer your questions live if you happen to drop those in the chat box before the end of the video. So if you have questions on anything along the way, go ahead and put those in and we'll discuss that. But today we're going to be talking about why diversify, right? So it's been a wonderful year in the US. Some of the global market looks crazy, but I want to talk to you about why you might want to consider this, especially if you're within just a couple of years of retirement. If you have a longer time frame, you have more time to make things up. If you're in your 20s, 30s, or 40s, you might have 20 or 30 or 40 years until you have to really worry about recovering. But if you're close to retirement, 5 years or less, you really want to be looking at setting up your portfolio in a way so that you can generate more consistent returns and really be careful with some of the potential large downturns which we have faced in the past. We're going to talk about that today. I do want to say Happy Lunar New Year to all of our friends who celebrate that. I actually forgot about it and then went out to dinner the other night on Saturday night, and it was absolutely crazy. Hour and a half, 2-hour waits everywhere. But Happy Lunar New Year to our friends who celebrate that. So what we're going to do today is just jump right into talking about our subject today. So the title of today's presentation is called Why Diversify, right? So right now, you may be saying, why the heck, Jason, would I want to diversify my money? I did 27%, I did 20%, I did 30% in the last year. And if that's the case, then that's great, but that probably tells me that you have a high equity allocation, so a high stock allocation in your portfolio, and you're probably heavily US biased, okay? And in all honesty, it's hard not to be US biased when you see what's going on here in the markets. And I think you should possibly still be US biased, but I do think considering breaking up your portfolio in a way to where if we faced, some sort of downturn, you wouldn't have to quite feel the whole brunt of that. And we'll talk about some historical downturns and what this might look like in between. So before we jump into that, I'm going to drop my disclosure here because I have to let you know that everything we talk about today should not be construed as legal, tax, or financial advice individualized to your situation. It shall be considered as educational, okay? But, there's some things that I'm seeing, and I really want to bring this subject up today because I do talk to a lot of people that are looking to plan for retirement, and I wanted to bring you something that I hope will open your eyes just a little bit here, okay? So the big challenge, okay? So the big challenge I'm seeing today is something we call recency bias. So recency bias is a very prominent investor bias, especially in times like this, where in the last year, we've just seen that, the S&P 500 on a terror, even the last few years, right? So recency bias is when investors recall and emphasize more prominently recent events in their decisions than they do in the near or distant past. Okay, so you have to remember, okay, if you're in your 60s and you're going into retirement, you might have 15, 20, or even 30, or even 40 years, right? There's a lot of people I talk to that have parents that are getting towards 100 or beyond 100, and they're still driving to the store to get their groceries, okay? So, folks, I know a lot of you think you're going to pass away before 70. That's not the likely case. Some of you will. It's just what it is. That's life. But the majority of people, if you make it to 65, then the average age for men is about 84, 85, and the average age for women is about 86, okay? We talked about that last week. I showed you the statistics there that were not things I just made up. That's from, there are multiple sources where that came from. So if I were you and you're in your 60s, let's say you're 65, I would plan for at least another 20 years. And that average mark of 80 or 84 and 86, that means 50% of you are going to live longer, okay? So if you're with your spouse, look to your left, look to your right, one of you is probably going to live past that average age. So these things that we're talking about here, when you're looking at investing for the long term, especially investing in retirement, where my personal thought is that it's more important to achieve consistent returns than it is to knock it out of the park in 1 or 2 years here or there. And we'll talk about why, and I'll show you some examples here. But when you're in retirement, most people, would really prefer to have that regular, consistent returns And in all honesty, if you all knew, from the people I talked to, if you all knew you can guarantee 5% or 6% all throughout retirement, most of you would take that over a 8 or 9% potential with a also 15 or 20% downside potential. But in reality, interest rates just aren't what they used to be. Equities are a reality for most people, that you need to have some equities in your portfolio, and that means volatility. Okay, so that means you can have volatility in your portfolio, and you got to protect against this. And there's definitely some things we're going to talk about today to look at. But recency bias, I want you to ask yourself a serious question: is when you looked at your portfolio at the end of the year and saw those gains, did you think about the time between 2000 and 2009 when the S&P returned nothing, actually returned negative? So if you did, great. But if not, then I want to talk to you about this right now. So in the last 12 months, the S&P 500 returned about 27%. It has been a spectacular year. Okay, this whole coronavirus thing has made the market drop a little bit today. I really hope, I guess there's one case in Orange County here. There's a couple cases, in the United States that they're finding. And so please protect yourself, okay? So, this whole thing looks like it's centered around one certain market where they were selling things like wild animals like wolf and bats. Okay, so don't eat wolf and bats, please, because this coronavirus is no joke. Stick to the normal stuff. But this stuff today I think is short term. But there are some things we want to consider, okay? When you look at the last 12 months, we've had a great and wonderful, spectacular returns. But what we can forget is not too long ago, there was a whole decade. So specifically from January 2000 to December 2009, where at the end, the S&P returned a negative 0.95%. Okay, so how would you feel if you had your money invested for 10 years and you earned nothing? Not only did you earn nothing, but you earned negative 1% over 10 years, which, you bring inflation into the equation, then that means you definitely lost more than just 1%. Okay, this is very real. Okay, and if you are, like I said, 2, 5, whatever it may be years away from retirement, you got to look at recent history. Okay, and I'm not saying things aren't good. I think things are good. I think we're still going to see good returns, but we may not see things quite the same way they were. And in all honesty, what goes up can come down. So if we see a 27% in 1 year, we can definitely say a fall in the following year, just like we saw in 2018, which was a negative return about 10% or so. So these things vary, right? So investment returns vary, but over time, being invested in the market, especially global markets, you've done very well, and it's much better than keeping the money in a shoebox under your mattress or something like that. Okay, we don't want that, but I do want you to be aware of this, and I don't think enough people are talking about it, to be honest with you. So I want to bring this up to you. Okay, so this period from January 2000 to December 2009 was known as the lost decade, and if you retired in that year, in the year 2000, with an S&P heavy portfolio and simultaneously drew down on your portfolio, even a quote-unquote safe 3 to 5% withdrawal, you may be currently experiencing the possibility of running out of money, even though the S&P has done quite well since then. Okay, so again, retirement is more about consistent returns versus knocking out of the park, at least for me. When we specialize in retirement income planning, what we want you to do is know where your money's going to come from, and make sure it's going to last for long times. And if we can avoid you experiencing any wild swings in your investment portfolio, that is always a good thing. Okay. So here's an example of what this could look like. So when you're going to retire, there's something called the risk of the sequence of returns. Okay. So it's like when you experience the returns, whether they're positive or negative, can have a very different outcome on your overall portfolio. So what I want to show you here is the difference between two investors, okay? And these folks, I've got Mr. Green on the left and Mr. Brown on the right. They both retire at 65, and they take a 5% withdrawal each year. And in this case, it's just a flat withdrawal. Normally, you probably want to add a cost of living, but this is an example I found I thought was easy to see. And the average return here was 6%. So on the left here, as you can see for Mr. Green, he retired in an up market, okay? So his first 3 years of returns were actually really, really good. This actually looks pretty similar to 2019, doesn't it? And then he experienced a little bit of downturn, but overall, some pretty good returns. And then here down the road in his 70s, he did see some big dips, like 26%, 15%, and then towards the end, even the last 3 years of his plan, he saw 10, 14, and 25% negative returns on his portfolio. And in this case, the starting value was $1 million. And in this case, he ended up with 2.5, even though at the end he experienced these negative returns. So essentially, if you look at the sequence of returns here, it started positive and then got more negative. Essentially, this is the exact opposite, right? Where it starts negative and then it has positive. So at the end, the investors both experience 6% average return, but they experience the returns in different order, right? This is what I'm talking about when I say the risk of the sequence of returns. So both we're drawing 5%. They both started with $1 million. But if you look at Mr. Brown here, in his first year, he started with a down market, okay? So he drew $50,000. Plus, he had a negative 25% return, which again is the same as the last year of Mr. Green here. But the first 3 years, he had pretty large negative returns in his portfolio. So this is what I'm talking about here. If you are overly invested in equities, and to be honest with you folks, I'm seeing this so consistently that people are 2-3 years out from wanting to retire, and they are very high in equities. And some of them are chasing returns because they don't think they have enough. Some of them just haven't paid attention because they're busy at work. But this is a very real, annual return if you're sitting at a high equity portion, right? So these are things that I want you to be careful of. And we saw things even like this in just more recent years. Again, I don't think things are bad. I'm not here to say, Dr. Doom. I think we're overall going a great direction in our country and then even in the world, by the way, besides this crazy virus outbreak. Okay, that's a side note. But overall, I think things are starting to turn for the better even in other parts of the world, but the U.S. has just been on fire. And so this could be something that could happen to you. So, you want to be very careful of the order of withdrawals because even though you average 6%, the order of withdrawals and the sequence of returns, excuse me, not the order of withdrawals, but the sequence of returns can really make a difference, even though if everything is exactly the same, and you average the same, but they come in a different order, okay? So I'm actually a bigger fan of going into retirement a little more on the conservative side, and then even considering increasing equity, so a rising equity glide path towards mid or late retirement, especially after you activate, maybe both Social Securities if you're married, maybe if you have some sort of pension. Once we activate those things down the road, if you maybe retire a little bit earlier than those are available, that's when we can start turning up the equities a little bit. But what I want you to avoid is something like this. So hopefully this is helpful for you to see that. All right, so now I want to talk to you about a tale of 2 decades. Okay, there's a really good article I saw that I think displays this. So I'm just going to go over this article with you, which I really enjoy. So this article is called A Tale of 2 Decades. It's from Dimensional Funds. So I do partner with Dimensional Funds for some of our investing. And this article really walks you through some lessons, I think, for long-term investors. And again, if you are in your 50s and 60s and you're looking at retirement, you should be considering yourself a long-term investor. So what we're going to do here is compare the market returns across the 2000s and 2010s. And then what I want to do is reinforce the benefits of diversification and pursuing known drivers of higher expected returns. Okay, so this article, let's start at the beginning. So the first decade of the 21st century and the second one that's drawing to a close. This was written at the end of last year, so it's a little bit dated, but still applies. So this is reinforced for investors some timeless market lessons. Returns can vary sharply from one period to another, so holding a broadly diversified portfolio can help smooth out the swings. And that's the point of diversification, smoothing out the swings. And then focusing on known drivers of higher expected returns can increase the potential for long-term success. Having a sound strategy built on those principles and then sticking to it through good times and bad can be a rewarding investment approach. So this is very important, okay? I want to drive this home because let me just ask you guys, how many of you right now are thinking about moving more money to the S&P or moving more money to the U.S. stock market than you have, or moving more money out of your fixed income investments because bonds are paying horribly right now and putting more in stocks, even though you might be a couple years away? If that sounds like you, please let me know in the comments. Let's be honest, okay? The first thing we can do when we have a problem is admit we have a problem. And then once you admit you have a problem, we can address it, okay? So the next thing I want to talk about here is the lost decade. So when you look at the U.S. stock market, and we just kind of use the S&P 500 as the measure of that, over the last 20 years, it's been a bit of a crazy ride. But the lost decade is here from January 2000 to December 2009. And it really resulted in disappointing returns for many who are invested in their securities all in the S&P 500. So the index on average has averaged more than 10% before 2000, but annualized for that period were negative 0.95%, right? But on the other side of the equation, it actually was a good decade for investors who diversified their holdings globally beyond the US large cap stocks and included other parts of the market with higher expected returns. So companies with small market capitalization, so small cap stocks, or low relative price, which is value. So I'm a big fan of small cap and value. There's a lot of data behind this. Unfortunately, the last decade or so, 7-8 years, value has not been quite as good. And in reality, it's the tech companies and the biggest companies that have really driven that up, because companies like that haven't made any profits. And even you look at companies like Tesla right now. Tesla's trading at over $500 a share. Just a few months ago, it was at $250. They're still not really making any money. I think Tesla is a good company, but when it comes to investable companies, it wouldn't be good if you looked at the actual numbers. But I still believe in Elon Musk, and I believe in the long term of it. But things are getting a little bit crazy right now. So here is the 2000s. Okay, so January 2000 to December 2009. So if you're in the S&P only, you would have returned a negative 0.95%. But if you would have had some diversification in some of these other sectors, like large cap value, you would return 4.14. Small cap index 8.86. The international, you would have been at 7.1. International small cap 13.46, and emerging markets you would have been at 10.97. So during this time, even though your S&P didn't do great, if you would have had some of your money in some of these other areas, you still would have had a decent average return, which again, I'm speaking here to our retirement investors, okay? When you're creating your own paycheck, consistent returns, I think, are more valuable than big returns in one year and then facing big downside on the other side. So, okay, then now we're going to flip the script, right? We're going to look at January 2010 to 2019. Well, during this decade, and this again is our most recent decade that we've experienced, right? Things that have changed around. The S&P's averaged 13.08. Large cap value hasn't done quite as well, been at just under 12. Small cap just over 12. International hasn't done quite as well at 5.02. International small cap's been 6.4, and then 4.1 for emerging markets. So, during the 2010s, we kind of had things flipped around. But when you're looking at a 20 or 30 year time frame, it's really hard to predict when these things are going to be happening. And basically, it's impossible. There's no evidence that anyone anywhere can predict these things consistently, exactly when to go in the market, exactly when to move out. So I encourage you to consider what we're seeing here and looking at some things on the long term, okay? And then, if you take the whole period into effect from January 2000 to June 2019, when I think this article was written, the S&P has averaged about 5.65, large cap value has done 7.84, small cap has done 10.44, international has done 6.08, international small cap 9.96, and the emerging markets has done 7.57. So again, like it says here, no one knows what the 10 months will bring or the next 10 years, but maintaining discipline and patience through the bad times and the good can put you as an investor in a position to profit, regardless of what's going on in the world. So, again, I know a lot of folks are not going to want to hear this right now. And in all honesty, it's hard even for me, right? I see what's going on in the U.S. I see that so many regulations have been lifted. I think we're on track for some good things, but there can be things that come up that aren't in our control. Hence, for example, this coronavirus, right? This coronavirus affected our markets at the end of the day. We think we're down about 1%. It's been the largest drop since the beginning of the year. But these are things that you want to be considering because even the S&P 500, the companies there are global companies in a sense. So yeah, it is diversified because those companies are global, the top ones in there. But still, these are things you want to think about that may impact you. And again, going back to consistent returns versus maybe necessarily higher returns. So here's what I want to share with you. Here's an example of, actually I have a few examples here of different time periods, okay? So I have the S&P 500 versus a global 60% equity, 40% fixed income portfolio. So this is just very simple, just using a couple index funds to make this happen. And we're looking at the S&P 500 versus the global 60-40. So on a 1 year time frame, S&P, if you're 100% S&P, you would have done about 27.24 in the last year. If you're global, hey, you would have only done a measly, 17.59. I think we can say most people would be happy with that, with less risk. But throughout the year, you got to look at some of these touch points. There was points in this where they did still come very close, but towards the end of the year, we had just a tear in the market, and it just went crazy. So it's just kind of what it is. Okay, and if you look at 5 years, okay, so again, we're looking recency bias here, last 5 years, 2015 until now. If you would have had your money in a global index, the first year and a half or so would have been pretty similar to the S&P, but then S&P really started taking off, and this is post-election, right? So you can see definitely here the S&P has been doing quite well. You would have had almost 78% return versus almost 44% return. So again, that over 5 years, that's a good chunk of money, okay? What I want you to notice, though, is this green line, which is the global 60-40, has been a lot smoother than the blue line, which is the S&P, which has seen significant dips like right here at the end of 2018. Okay, and then so now we're going to jump to a 15-year. So if you would have been, say 15 years ago started, and this is the exact same amount of money starting at the beginning, look at how close this was, right? So you're looking at 100% stock in the blue, 100% US S&P 500 versus a global 60-40 in the green, okay? So you would have seen some crisscross here. Once the market took a dip here in 2009, the S&P definitely had a bigger dip here. The global portfolio did not have as big of a dip. So again, reduced downside, lower risk. And then S&P eventually caught back up, about 1, 2.5, 3 years later, crossed over here in about 2013 or so, a little bit after. And since then, S&P has been outpacing in the last 15 years. So again, we're looking a little bit longer, and it still looks like the S&P might have won. But now look at over the last 20 years, okay? And I think for most people, this is a reasonable time frame to be considering. Because if you're looking at like 65 to 85, retirement to 85, look at how this is played out on a 60% global stock allocation, which is the green, versus the blue, just everything in 100% stock in the S&P 500. So pretty interesting that, because of this last year, right? So the S&P really took over here in the last year because we've had a great year. But prior to 2019, you would have been ahead here from about 2002 all the way until about 2018. So let me ask you this. If you were a retiree and you were in retirement and you're generating your own paycheck out of your investments, what would you rather have over the last 20 years? And I'm not saying 60-40 is right, by the way. Okay, it's not the end all be all for everybody. Maybe it's 50 or maybe it's 40% equities for you, and maybe it's 70 or 80% equities for you. All I'm saying is, looking at a globally diversified portfolio could possibly have some benefits over the long term. So, just to really, be careful. And if we have another great year in 2020, you guys are probably going to come back and say, you know what, Jason, you're wrong, and, you suck and whatever. But I think if you are looking forward the next 10 or 15 or 20 years, and you're trying to generate more consistent returns, I think having somewhat of a diversified portfolio will, may pay off better for you when it comes to generating that consistent paycheck. So, think about it. If you would have gone from 2002, let's say, all the way to 2018, so 16 years ahead until the S&P finally took over, and you had a much smoother ride, a lower downturn, when we did have downturns, how would you feel, right? So most retirees I know would much rather have a smoother ride, more consistent returns, than potentially ending up a little bit higher, but not seeing that return for over 20 years. So that's think about that. That if you're started at 65 back here, and then now you're 85, 84, you finally came out ahead. I don't think most people would want to be doing that. So again, we don't know what could come in the future. I'm not trying to predict the future here. All I'm saying is I think there is some value to diversifying beyond something just like the S&P. Maybe even considering value or some international in your mix to smooth out that ride over time, okay? So hopefully that was helpful for you. Okay, now the next thing I would like to talk to you here about is considering risk, okay? So the upside looks great, but what about the downside, okay? So here, the green is the S&P 500, is the global 60-40 allocation, and the blue is the S&P 500. So this is where I think having that diversification can really be helpful to you, because in like the worst of the worst times, okay, so we have the tech bubble here in 2000, we have the World Trade Center attack, we have the subprime crisis of 2018, we have the debt ceiling crisis, I believe that was 2011, the China slowdown, I can't remember when that was, it was 2000 something, 2010, like 13 or 17. And then we had the 2018 Q4 sell-off where we had that big dip at the end of the year. If you were looking, not necessarily at the upside, but at the downside. So think of this, like if you're starting with a $1 million portfolio and you have in the subprime crisis, your portfolio is down to 600,000 or it's down to 750, not saying either one is good, but what would make you freak out more or less, right? These are some serious things to be thinking about. And especially, in other more recent times too, like in the, Q4, instead of being down 20%, you would have been down 10%. This is more recent. I know a lot of people that, sold off everything at the end of 2018 because they got scared again, just like the same thing that happened here. And then they missed out again in 2019. So the idea is that I want you to stay in the market and I want you to rebalance along the way. And I want you to have the right risk tolerance and the right portfolio so that you can stay invested, because staying invested is so much more important than trying to jump in and jump out. Because in reality, if people could do that profitably, you could sell your advice and make a whole lot more money than you probably have right now. So I want to see if there's any questions, which I don't see. Let's take a look here. Yeah, I don't see too much here, except not sure where to put money. So these are things, okay, so where to put money is going to be individualized to you, okay? So everybody needs their own individual portfolio that matches up with their risk tolerance, timeline, and goals. So, hopefully this was helpful. If you guys want to discuss your portfolio, you want to discuss where you're at from a risk perspective, and if you want to discuss if you're in the right place, if you're properly set up for retirement, I do offer a complimentary retirement strategy call, and I'd be happy to chat with you about it. So if you'd like to discuss your retirement planning situation, because investments are just one thing, folks. Investments are one thing. We got to look at investments, Social Security timing, pensions, distribution strategies, tax planning. There's a lot of things to consider. Long-term care, how to fund that, whether it's through insurance or on your own. There's a lot of different things we talk about on these calls, and there's some areas here that if I can point those out to you, maybe we can find a way to get you a plan so that you don't end up get caught with your pants down. I'd love to help you out with that. So I do want to mention here below, if you want to specifically talk about a portfolio review, be sure to note that so then I can send you a link to upload your statements ahead of time so that I can have some data ready and available for you. So once again, that's keepitsimplefinancial.com/talk, keepitsimplefinancial.com/talk. So let me go back to my other screen here and I'm going to check for some questions, see if we have any questions here. And while I do that, I'm going to pull this up actually. Let's see here. So yeah, so this is common. This is a common question here. This is a common question. So Kathy says, she's close to retirement, 3 years, have money, not sure where to put it this year. Kathy, this is probably the most common question people are going to have. They're going to be just like you. My thoughts are you need to look at your retirement income situation. So thinking about if you're retiring in 3 years, are you going to take Social Security right away? Are you going to be delaying a few years? Because I don't know how old you are, by the way. Are you going to be receiving any sort of pensions, annuities, or any other sort of fixed income? These are all things that are going to come into play when it comes to where to put your money. The way I look at it is I like to think in retirement, your retirement time frame in segments, right? So there's going to be money you need like the next 2 years, let's say, for example. We don't want that money going anywhere. So maybe that money needs to be in very safe type of situations like cash or money markets. But money you don't need for 20 years or more, then that's money we can take a little bit more risk with, right? So what we need to do is create a retirement income plan for you so that you can figure out, how much you're going to need in each segment, right? So like, let's say every 5 years over retirement. So if you have a 25-year retirement time frame, every 5 years. And then for each of those segments, depending how much you need, we will section off a portion of your money to make sure that money is funded. And then we'll have different risk levels along the way with an increasing risk of money that you don't need for later down the road. So that's how I want you to think about it. But there's some other variables we need to talk about in this particular question here. Okay, let's see what else we got. Okay, so here's one I see all the time. Retired 2 years ago, 80-20 equity versus bonds. Okay, so if that's your 80-20, then maybe that's okay for you. But if you can face a 30 or 40% downturn for 2 years and not worry about it, maybe that's all right. Maybe you have a lot of income. But this is what I'm seeing. And for most people, this is probably too high. For most people, this is probably too high of an equity portion. But again, everybody's individualized, and I don't know what sort of income streams you may have. But 80-20 is quite high for somebody who is just 2 years into retirement. Unless you have, again, enough fixed income, for example, through pensions and Social Security to cover the basics. then maybe that's the right thing for you. So this is what I'm seeing a lot. And I'm seeing this with people that are 2 years away from retirement a lot more because they're trying to squeeze out extra income. But if this dips, folks, and things change in the next 3 or 4 years before you retire, it could definitely be hurting you on the downside. Okay, let's see here. Okay, I've got a question here from Chris. So Chris asks, is it smart to use Roth and as an emergency fund as well as supplementing 401k? So let's talk about Roth as an emergency fund. So the nice thing about Roth, let's use an IRA for example, because 401k is different rules. But let's say you're going to put money in a Roth IRA. And let's say you don't have your emergency fund saved. Let's say you're starting at zero today, or maybe you only have $1,000 of cash, and you're trying to get to that coveted 3 months to 6 months of emergency savings put aside. I have seen people use Roth because the interesting thing about using a Roth for an emergency fund is you can take the money out anytime you want, essentially. So with a Roth account, a Roth IRA, I should say, you can put money in and you can take out your contributions at any time. Earnings have different rules, right? So 59.5 for 5 years, they need to be in there, or other special circumstances like purchasing a home or whatever it may be. But so if you're just getting started, a Roth could be an okay way to use it as an emergency fund, but I would not recommend that you start investing that money if you're using that as an emergency fund. So a Roth account will just work just like your bank account, except that you are taking advantage of your $6,000 or $7,000 contribution limit, because once that's gone, you can't get it back. But I would encourage you to wait until you hit at least 3 months of expenses before you start investing any money there. And then I really want you to have that emergency fund outside of the Roth, because the Roth money is so valuable that for most people, the majority of people, you don't want to touch your Roth money until the last money, right? So if you have taxable brokerage accounts and then tax-deferred accounts like IRAs and 401ks, you probably don't want to touch any of your Roth money till that's all done. The reason being is because Roths do not have required minimum distributions at 72. Roths do, if you do pass a Roth on with our new Secure Act, if all that money has to come out in 10 years, that money's not taxed. Where, traditional IRAs and 401ks, you do have the required minimum distributions, and you will have to take that money out in 10 years. So ideally, you do not want to use your Roth as an emergency fund, but if you're starting from zero and you're just trying to build things up and you have no money saved anywhere, then it could be an okay way to do that. And and then also obviously supplementing the 401k could be okay, because 401k can maybe be some pre-tax money, Roth can be post-tax money. So if you have pre-tax and post-tax, now you have tax diversification. So that's 2 different buckets that you can pull from in retirement. So I don't think that's not a horrible idea, but it's not my perfect idea. So John asks, do you consider Social Security and any pension annuities into your ratio mix? Yeah, sure, John. Absolutely. That definitely is part of it. So Social Security is more like a floor, right? It's more of an income stream. So like a floor. So if you have a Social Security and you have an annuity or a pension, you're going to have floors that stack up. You have that base income. So the higher percentage of your income need that money covers, then probably the higher equity portion you can withstand in your portfolio. The idea is that the money you need to cover from your own investment, so not including fixed income, somewhere between 2 to 5 years of very safe money, so that if there is a market downturn, a market dip, you're not worried about that in the short term. Okay, that's kind of the idea. So depending how much of your income need is covered by these fixed income instruments, that's how you make your decisions on your equity mix. And again, this is why I say everybody needs an individualized plan. 60-40 is not right for everybody. 80-20 is not right for everybody. And some should be higher, some should be lower. So I hope that is helpful. So Dan asked, how does the Boglehead 3 fund strategy fit within the last 20 years? So Dan, that's basically what I was showing you a second ago, by the way. So the Boglehead 3 fund strategy is essentially, you own the total stock market index, total U.S. stock market, total U.S. bond market, and then total international market. And you can put a fourth one, if you want to have total international bond market, and maybe even a fifth one to add a little bit more of another sector in there, like small cap or something like that. So I'm very familiar with the 3 fund strategy. So Dan, overall, that's what I showed you basically, because we had, I don't know the percentages offhand, but it was 60% equities and then 40% fixed income. And I did have basically the total market, total international, and then the total bond market all mixed in there. So that is what we saw right now. And that's a perfect example of what we're saying here. So cool. So that is what I'm seeing for questions today, folks. I am going to throw up my website here if I can find it. Let's see if this will do it here. Let's see if I can do this here. There we go. All right, so if you want to chat about your situation, you can go to keepitsimplefinancial.com/talk and schedule an appointment. Appointments are very limited. March, I'm going out of town for a couple weeks. So if you want to get in and speak about this soon, I would highly recommend you do, guys. The market is up. You don't want to be caught with your pants down. You want to get your things and your investments in place so that you are ready. If you're retiring in the next 2 to 5 years, I would definitely recommend booking a call so that we can chat and get you on track towards a better retirement situation. And we will go from there, folks. So if you need anything else, you let me know. Leave a comment down below. Other than that, I appreciate y'all watching today, and I will see you next time. Have a great day, and happy Lunar New Year, happy Chinese New Year, and we'll talk to you next week. Bye.